Hello traders, and welcome to another educational video here at ROI Forecast channel. In this video we're going to have a look at why 90% of traders fail because of lack of risk management in trading, and we are going to teach you how to do that correctly. Now, first and foremost, before we go to the calculators, we will have a look at certain things in theory so you can understand what we mean. First of all, when you trade Forex, specifically this is for Forex, the contract sizes are fixed to 100 contracts per lot. So if you are opening one lot in Forex, you are actually trading 100,000 contracts in that pair, which of course is not a little. You need to understand as well the pips and the pip value, as well as the calculation of your stop losses and the calculation of your risk to reward and take profit targets to be efficient in your risk management. Of course, this is what we do as well for our membership service. We provide all of the recommendations based on risk to reward and also value. So we do calculate everything when we recommend something to the traders, but for this video we are going to have a look how you can calculate this so you will never again open a bigger than you should trading position, and you should respect the risk management of your account. Now, secondly, for a healthy risk management, the industry standard suggests 1 to 2% risk per trade, which means that you need to calculate your position size, and according to your stop loss, you should not lose more than 2% of your capital per trade. This is the industry standard. Now, for our traders and our members, we can recommend up to between 2 and 5%, and the reason is because we have a great trading system which allows us 70 to 80% of our trades to go on risk-free or a very small risk, because we are moving the stop loss as the market goes in our favor. So we do have a different edge and trading system that the majority of systems out there in the market. So if you are a member, you should know that from the member area how we are actually managing and how we analyze the markets to be able to afford a little bit higher risk per trade, but this is the maximum we can recommend for our members. If you are not a member and your trading system is not stable, of course you should not risk more than 1 to 2% per trade. So now we are going to jump into some calculators, which everything is free online, and the only thing a trader should do is really play around with it for some time. Take the time to learn how to do those calculations before you make your next trade. Now, this is the first calculator we can have a look at from my FX book. Very simply, if you go on Google and you search profit calculator my FX book, you will get the link and you will open this website. So here we can select the currency pair that we are trading. As you can see, they have pretty much everything you will be trading. So for this example, we are going to use Euro USD because it's the default one, just to simplify things. So let's assume we have a US dollar account. Of course, you can have a pound, British pound, euro, Swiss franc, Australian dollar, Japanese yen, depending which account currency you are using. For this example, we are going to select USD, which is the default, and we are going to assume we are buying euro dollar at 106. I will make this simple so it's not complicated. This is the trade size in lots. As you can see, if you put your mouse here, you can see one lot equals to 100 units. That's why we have set 100,000 contracts in size. And you can also check this up with your broker on your contract specifications on your MT4 or MT5. Of course, if you don't know how to do that, you can have a tutorial video online. Everything is easy to learn how to use MetaTrader, but overall, this is how the Forex market works. So let's assume we are buying at 106 euro dollar, right? And let's assume we are going to put a stop loss so we can limit our risk. So let's say we have decided to put our stop loss about 200 pips, let's say. 20 pips, my mistake, 20 pips from our buying price. So it's going to be 105.80. Or if you have an extra digit like this means it's a point. So the pips will always be this denominator here, and this one is a point. So let's calculate then. As you can see, if the market hits our stop loss with one lot, we are risking to lose $200. Okay, which this is 2% of a $10,000 account, or it can also be a little bit higher, like 4 or 5% if your account is 7,000, for example. So what we're trying to say here is that the person that should be trading one lot if the stop loss is only 20 pips, okay, this is very important, because if you don't know how to trade, if you don't know how to find proper setups, and you have a bigger stop loss and you don't know what you are doing, you are increasing also your risk the more bigger stop loss you have. But this will depend on your trading strategy and your trading style. Of course, if you don't have a trading strategy, you can consider becoming a member, so we can share with you how we are trading efficiently and how we have a 70 to 80% of the time we have a risk-free position when the market moves. So for this example, we are going to just see right here, as we have said, 20 pip stop loss, okay, from our buying price. If it's one lot, we are risking $200. Now, if your trading account is between $1,000 to $2,000, then the position size you can do is maybe 0.10. As you can see, you are risking $20, or you can go up to 0.16, perhaps $32, or 0.20, which is $40. Okay, so the maximum lot size you can open per trade, if your account balance is 1,000 to 2,000, is 0.2. Okay, now because this $40, as you can see, it's 4% on a $1,000 account, or it's a 2% on a $2,000 account. I hope that makes sense, and this is how you can play around with this. And you can also see over here, if you scroll down, you have gold, right? You have gold and silver as well. You have platinum, palladium, you have some metals here. So let's have a look at another calculator here from FX Verify. The reason why this calculator is also useful, as you can see, you can find anything you want, including indices, for example, or if you trade anything else like futures and stuff like that. So let's take, for example, if we are trading the S&P 500. So we have over here, if you search SPX, for example, you have a cash index over here. Okay, the same idea. You can put your currency of your account. You can put your buy or sell order, whatever you are looking to trade, and the unit size. As you can see here, this website suggests as well, you have to check on your MT4 or MT5, right click on your symbol and select specification. So the contract size fields tells how many units are in one lot. I will make a separate video on how to check those contract sizes and how it works other than Forex, because only in Forex is simplified, everything is the same as 100,000 contracts. So on the other markets, cash indices, or whether it's futures, or whether it's other metals and commodities, you need to do the calculation a little bit differently, but still with this calculator here, it's everything automated, so you don't really need to do anything manually. But of course, if you understand how it manually works, it's even better, because this way you get more experience. So let's assume we are going to trade one lot in US 500, which is the S&P 500 cash index, not the futures, and I will show you why it's different. So let's assume we are buying at 5,100 and we have a stop loss at 5,050 over here. Now, if I'm going to trade one lot in the cash index of US 500, and I have a $50 stop loss from my buying position, it means I'm risking $50. Okay. Because the cash indices, their tick value is 0.01, so that's why with one lot it's actually $50 when we have $50 drop or up. So the other way, if I'm going to have a $50 take profit, I'm going to make $50, as you can see. So let's go back here. So if I'm going to have a $50 stop loss in this trade, I can, if I'm risking one lot, it means I'm going to lose $50 if my stop loss gets triggered. So those $50, if you do the calculation on your account size, if your account size is $1,000 to $2,000, you can afford to do this trade. Okay. Now, if your trading account is bigger, perhaps you can increase the lot size and play around to see what is your maximum limit you want to be risking, right? As we have said, the industry standard is 1 to 2%. For our traders, we recommend them between 2 and 5% because we have much more confidence and we know our system, how it works, and that's why we are able to take a little bit higher most of the times. Now, let's do the other way around. Let's say we have 0.5 lots. As you can see, our risk is half because we have half the lot size. The lot size can go as low as 0.01 for those that are curious, and it can go from there higher. As you see, 0.01 is 50 cents. Now, let's see why the futures are different from the cash indices. Just for this calculation. There are also other differences which we are not going to cover in this video because it's going to be too long. So for this video, we focus on the calculators right here, so how you can do your risk management. So now the ES 500 futures. I don't know if I can find it here. Let me see if they have it. So they have all the cash. So it doesn't look like they have futures here. So let me see. Yeah, they don't have the futures here, guys. So just for another example, we can do the another index for here. Let's say US 100, which is Nasdaq. Let's say you are buying at 18,000, right? If you have stop loss 17,900, which is 100 points, you are risking $100 per one lot. Okay. If I do 0.1, it's going to be $10, and if I do 0.5, it's going to be $50. So here's how you can check on the cash indices. They don't have for the futures, but I'm going to have another video and I will speak to the futures because anyhow, not many retail traders, they know how to trade futures, and most of them, they trade on the cash indices. So it's still similar idea. So this is how you use this calculator to calculate everything, including if I go to gold, for example, over here, I can do the same for gold. Let's say I buy gold at 2,300. I have a stop loss at 2,280, $20. I'm risking $20 in this case, but this is not correct because of the trade size contract over here. So for gold, I do not recommend this website to calculate your positions. For gold, you can use this one over here, which is from my FX book. As you can see, $10 drop in gold. You are actually losing $100 dollars if you are using a 0.1 lot size. Okay, so I will make another video, guys, regarding how to calculate the contract sizes of the other instruments other than Forex, and you can use this calculator over here for Forex, all the Forex pairs, and you can also use this one over here for your cash indices, which is available for free online, these calculators. So next time you are trading, make sure you do your calculations before you hit the trade button, because the moment you hit the trade button, you are already entering into a risk. So make sure you do that correctly. If you don't know how to trade correctly, and if you don't understand certain things, you are welcome to join our membership service with the link down below, and we can help you out and explain to you how you can trade efficiently and how you will be able to manage your trades. We do have live sessions Monday to Thursday with the premium plan, and you are welcome to email us at support@roiforecast.com if you have any questions, and stay tuned for the next video, which is going to be tomorrow with the weekly market forecast, and then we are going to cover in the next couple of videos about how to calculate the contract sizes and positions on the other instruments other than Forex and cash indices.